I spent 10 years in the asset management industry analysing funds, and these are the 4 types of fund I wouldn't put my money anywhere near. Because once you've seen how these products get built, and more importantly why, you'll look at them a bit differently. Over the last 10 years, just 24% of active funds have beaten a comparable passive fund, and it's worst in the world's biggest markets. In North America, it's 13%. Global funds are the same, and the UK is not much better at 17%. I've seen the side of active management where they're incentivized by the wrong thing. Asset managers don't earn from the performance of funds. They earn from assets under management. Regardless of performance, an annual management charge is always taken. Of course, they want the fund to perform well, but they can earn a lot more by including some popular names that new investors recognize. It's all about net flows. In any performance meeting I had, flows are always the first stat talked about. There's also what's called closet index funds. These are active funds that are extremely similar to an index, but come with a higher fee. Always look through holdings of an active fund and see how many companies you already have exposure to. But this isn't to say that all active funds are bad. There's some really good active fund managers out there. It's just that in the bigger, more efficient markets, it's harder for them to find an edge. Where you're more likely to see outperformance is the smaller, less efficient markets. Companies with less analyst coverage and less information generally. A fund manager will meet with senior management and build a proper picture of how the business is actually run. Sometimes a company can look great on paper, but under the surface, it's not. Or they'll see a company getting a bad rap in the media, but it's actually doing fine. You can see it in the same AJ Bell data. Over 10 years, 53% of active Japan funds beat their passive alternative. Emerging markets, 48%. The US, 13%. I should say though, the last decade has flattered passive funds a bit. Returns have been driven by the very biggest companies, and a tracker fund automatically holds the most of exactly those stocks. Active managers tend to be underweight this top end of the market. In AJ Bell's first report back in 2021, 56% of active funds had beaten their passive alternative over the previous 10 years. So these numbers swing a lot depending on the decade you measure. But there's still only 3 areas of active management I would consider. That's dividend funds, emerging markets, and bond funds. Dividend funds and trusts do a different job. You're not paying them to always beat an index. What you want is income that grows and doesn't get cut. Emerging and smaller markets benefit from specialist knowledge in a specific area of the market. And active bond funds often outperform their benchmarks more consistently than equity funds, as the fixed income market is highly inefficient. It's dominated by central banks, insurers, and pensions that have to buy or sell bonds to meet regulatory mandates rather than to maximize profits. Of course, it doesn't need to be an all or nothing approach as well. You could have a core and satellite type portfolio, say 80% of your portfolio in passive index funds, and the remaining 20%, you can be a little bit more active. That could be choosing investments yourself or going with a fund manager. Just watch the overlap again. If your core is a global tracker fund, it's already dominated by large US tech stocks. So you probably don't need a US large cap fund manager as your active part. When you start a new job, you get put into whatever fund your workplace pension defaults you into, and you'll most likely never think about it again. The problem is that default fund is usually far too conservative, and it uses an outdated concept that could cost you thousands in lost growth. When you're young, the fund will be predominantly invested in equities, and then it will gradually shift you towards bonds as you approach retirement age to reduce your volatility and protect your capital. In theory, it's a good idea. In practice, it often starts happening far too early. Some schemes start shifting you into bonds as much as 15 years before your target retirement date. The thing is, these funds were designed for the annuity era, where you had to hand your pension to an insurer, so locking in its value beforehand was exactly the right thing to do. But since the Pension Schemes Act in 2014, you've got a lot more choice in how you access your pension. And for people choosing drawdown, that money might stay invested for another 25 to 30 years. Nest, the UK's largest workplace pension provider, takes this caution to another level. Their highest risk fund isn't even 100% equity. So you could be 25 years old and have bonds in your pension, despite being potentially 40 years away from retiring. And it gets worse. They have a foundation phase for younger members, which aims to grow your pension just above inflation while keeping volatility down. That's barely any real growth by design at the exact point your money has the longest compound. They say these features keep people invested and soften the impact of investment shocks. I just find this bizarre, as most people don't even check their pension. If you have 30 years left before you plan on retiring, Holding a meaningful chunk in bonds is far from ideal. Bonds are there to protect what you've already built, and at 25, there's not much to protect. They're trying to keep investors happy. But you know what really makes investors happy? Growing their pension so they'll have more to live off in retirement. Research from Columbia Threadneedle put the average performance drag from this de-risking at about 2.3% a year. That works out around £12,000 off a typical £100,000 pre-retirement pot. One of the pensions I had when I worked at Invesco was with Aviva, a fairly typical pension fund, actively managed with a mix of equity and fixed income. I was in this pension from the age of 22. Performance-wise, over the last 10 years, it's returned around 98%, which doesn't seem so bad until you look at what a typical global ETF would have returned in that same time. Vanguard's FTSE All-World Fund has returned about 231% over that same period. The supposed safety asset also failed just a few years ago. When interest rates jumped in 2022, mid to long dated bonds, exactly the thing a default fund holds more of as you approach retirement, collapsed. And the longer dated the bond, the harder it falls when rates rise. You do get a slightly higher yield for taking that risk, which is why they end up being attractive to pension funds, but not exactly what you'd call capital preservation. What I'd say is check what options you have with your current workplace pension. If you've got previous workplace pensions, you can easily combine them into a SIP where you'll likely pay lower fees and have far more control over what you're invested in. Just check the old scheme for any guarantees or protected benefits before you move it. Some older pensions might have valuable perks you'd lose by transferring. If you want help with this, I run an investing community called Zero to Investor where we discuss exactly this type of thing. It's linked in the description below. If you've ever looked into monthly paying ETFs, you've probably come across covered call funds. Many of them produce double-digit yields and they've become extremely popular in the past few years, but they come with huge trade-offs. The basic strategy is you own the underlying stock, and to produce extra income, you sell call options on it. A call option gives the buyer the right to buy that stock at a set price, the strike price, and they pay you a premium for it. If the stock climbs past the strike, the buyer takes it, so any gains beyond that point aren't yours. If the stock falls, you keep the premium, but you ride the fall with everyone else. And that's the key trait of covered calls. Your upside is capped, your downside basically isn't. The appeal is you've got three sources of return. You still own the stock, so you still receive dividends. You get some price appreciation up to the strike price, and the premiums come in regardless of what happens to the price. But that capped upside means if a stock goes on a rally, you can't participate in all of it. If it crashes, you still take most of the downside. The premium just slightly cushions it. And this means the biggest risk to the strategy in the long run is in its recovery from downturns. It can't recover as quick as just holding the underlying stock because you have that capped upside. To show you what this looks like in practice, I'm going to compare the JP Morgan US Equity Premium Income Active Fund to a typical S&P 500 tracker from Vanguard. See how similar they are at the end of 2024 through the early part of 2025. Then we had Trump's Liberation Day tariffs, which saw a global sell-off in equity. This is where the covered call fund holds up better because it's still receiving premiums on the way down, but it's the recovery where it then can't keep up. See how the lines diverge. In March this year, there was a brief sell-off which causes the lines to come back together before another recovery which sees the covered call fund flatline while the stock market rallies. In 18 months, the covered call fund has returned about 7%, including income. The simple tracker fund returned around 27%. You'll get a high yield, but you can essentially just see it as capital being converted into income. These funds do have a cult-like following for some reason, but don't fall into the trap. There's FOMO, and then there's fear of losing. Investors feel the pain of losses far more acutely than the joy of gains. It's called loss aversion. We tend to overestimate the probability of negative events. Buffer ETFs play directly on that pessimism. Buffer ETFs are funds marketed as giving you exposure to the stock market with some level of downside protection to smooth out the ride. They aim to keep people invested by absorbing a certain percentage of market losses, often the first 10 to 15%. The trade-off is that your gains are capped too. But is this sacrifice in returns worth it? These funds have only been available in the UK since late last year, so there's not a great deal of past performance to go on. But we can compare from the start of this year using two buffer ETFs from BlackRock that track the S&P 500 against a typical tracker fund. The first is this iShares US Large Cap Moderate Buffer ETF. You'll notice they've all got a month in the title. That's because to get the full benefit of the protection, you need to hold the fund for the full year from launch, and BlackRock are creating a new one every quarter. With this particular fund, you get loss protection on the first 10%, with an upside cap of 16.25%. They do also have a max buffer version. That one protects you from 100% of losses, with the upside capped at 6.39%. From the start of the year, you'll see how closely matched the three funds were, as the market was predominantly moving sideways. The beginning of March then saw a small correction, and it highlights the buffer ETFs doing their job. But it's in the recovery they really suffer. The typical ETF in blue more than makes up for its losses and overtakes both buffer ETFs. With capped upsides, they just can't keep up. You're also paying a higher fee. These BlackRock funds charge 0.5%. An S&P 500 tracker costs 0.07%. On paper, it's pretty clever financial engineering if you want that very specific payoff profile. But it's not without its problems, as detailed in this 2025 paper in the Journal of Portfolio Management called Rebuffed, an empirical review of buffer funds. They found that buffer funds often underperform their reference assets in both returns and risk-adjusted terms, despite being marketed as investor-friendly solutions to equity volatility. The promised downside protection is inconsistent in practice, with realized losses frequently exceeding what investors might expect, especially outside the narrowly defined periods. And simple alternatives, like mixing equities with cash, generally outperform buffer funds on average, even in drawdowns, raising questions about whether these products truly serve investor goals or just cater towards behavioral preferences. If someone thinks they need buffer ETFs to sleep at night, it's probably a sign they should review their asset allocation rather than adding a complex product with high fees to their portfolio. So all four of these play to a specific bias. Active funds sell the hope of beating the market. Default funds sell to inertia. Covered calls sell an income illusion, and buffer funds sell to loss aversion. And that's what I meant at the start about why these products get built. Every one of them is engineered to be sold, and the more moving parts an investment has, the more of its return tends to end up with the people who built it. The industry isn't slowing down either. Last year in the US alone, over 1,000 new ETFs launched, and 83% of them were actively managed. For the first time, there are now more US ETFs than listed US companies. And plenty of those launches I also wouldn't touch either. Single stock ETFs, leveraged ETFs. There's also some longer dated bonds I'd avoid for exactly the reason we covered in the pension section. So the two questions to always ask yourself: do I know exactly what I'm giving up for what I'm getting? And who's on the other side of this trade? As John Bogle famously said, you get what you don't pay for. If you've been looking at adding individual stocks to your portfolio, watch this video next so you can avoid the mistakes most investors make. Thanks for watching.